region around the Great Lakes has been called the heartland. When it comes to agriculture, there's hardly an area in the world that compares.
Everybody, just hold on. I don't know what we're going to have here.
That's what brings the viewers back. That a boy.
Manage money, piling in.
Double digits higher.
So at this point, we're in kind of uncharted territory.
There's a lot of money on the sidelines.
So that was a crazy one.
Good morning, everybody. It's Tuesday, July 8th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you get any questions or comments, please feel free to drop us a line in the chat area. We'll be sure to get to it during the show. Overnight markets here had September corn down 2.5 at 401. August soybeans were down 6.5 at 1025. And September Chicago wheat was down 4 at 544.5. This morning, we had a couple of export sales announcements from the USDA, 144,000 metric tons of meal to the Philippines. Of that balance, 97,000 is for 24, with the balance of 47,000 for 25. Also announced 112,776 metric tons of corn to Mexico, and that's for 25. So a couple of days in a row here of business to Mexico on the corn side. Yesterday afternoon, we got crop conditions. Corn improved 1% in the good to excellent category, is 74%. That is higher than the average of 65%. Soybeans stayed steady, 66% good to excellent there. That's ahead of the average as well, as 62%. Spring wheat, 50% good to excellent. That dropped 3 points from last week and 5% below the average there for the spring wheat. And winter wheat, 53% harvested. So we saw a little bit of a jump there, 37% last week. And we're almost back on pace there. 54% is the average. So good morning, guys. Not a whole lot of, excitement here in our grain markets. Obviously seeing corn ratings go up a point. I think most were kind of looking for that in the trade yesterday. We've got yesterday afternoon, 25% tariffs announced on Japan and South Korea. So interesting there. Hopefully it's a nudge to maybe get some sort of a deal done, but those are two large trading partners. So I don't think the market's really reacted kindly to that. They were, however, only slightly higher than where they had been. So it wasn't a drastic increase, but still, I think just the whole optics of the situation. And looking at commitment of traders, funds continue to pile in on the short side of corn. So Dustin, maybe kick us off with a few thoughts here. Also wanted to talk a little bit about, we were having a discussion this morning just on some of the farm bill stuff as it pertains to the big, beautiful bill that was signed. I know that you've had time to dig in and look a little bit deeper into that, but just some of the thoughts you had there in terms of how that's affecting, the overall marketing of corn and beans here.
Yeah. So, just kind of catch up real quick on the, the Japanese tariffs, I think, are probably the biggest concern. So, what's probably the biggest heartburn is, going into Thursday, we were expecting the potential that there was some sort of good trade deal on the table. And, what do we get? We get good weather over the weekend. We get, Trump saying that there's really nothing of substance in the speech. And then we're slapping our second largest corn buyer with, 25% tariffs. So that was like a complete reversal. So the chart actually looks quite messed up in a way, because obviously it was taken off guard by this. Of the 895 trading days that these 25 contract has been open, that was the largest break that we've had yet on a daily move. So it's not a good move. So immediately we go back to what just passed in the farm bill, because we're going to need it, right? We're going to need the coverage. And we're just talking about the risk reward of how we lean on that coverage, because, it's a marketing year average. And what are the chances that you're going to be able to successfully market in the exact same window that the USDA records a marketing year average? What if your market is experiencing extremely weak basis levels compared to the national cash price? So we can't, it's not a foolproof thing. It's not like we can just count on it like an LDP or, a direct payment. But let's just say it's strong enough that it probably will result in some fairly large payments at the trajectory we're going. So let's start with Ark County. It's moved to a 90% coverage level from a 503 price. So, good chances if you have average yields that, you're marketing your average payment's going to start somewhere in the 450s. We're down at 417 today on the board. Take your basis off of that. I think that's going to be substantial. They also raised the coverage level to 12.5%. So Ark County looks like it's going to be the one that would trigger. And again, this is something you don't have to choose anymore. If you chose PLC, you're still going to get the benefit of Ark County if that's the higher payment. They stated that they're going to automatically pay the higher of those two payments in the bill. Now, if your county has really, really good yields, that's where Ark County would potentially not be the stronger one. PLC is now, probably a bigger factor. And what they did in the PLC price for corn, they raised the minimum from 370 up to 410. When you go to the Olympic average, that only gives us one extra penny from what we were projecting before. So 427 price is what we calculated. I haven't seen any other data that says different, but 427 marketing your average is kind of a floor then for all corn base acres through that marketing your average. So what Dan and I were talking about before this is, let's say you're a grower that has to sell everything in October, and you might see some big, deep harvest discounts at that point in time where if you're planning to spot sell at harvest, you might be taking a 350, 370 cash price under certain situations, thinking that the farm bill is going to bail you out. But then you have some sort of over the winter extreme rally, maybe like what we saw in 2021. If there is some sort of trade deal inked by then, for example, that takes the marketing year average well above that 427 price again. So that's where you have to kind of be a little bit cautious to lean on this farm bill, because it may not match up to your marketing window, especially if you sell everything at harvest. There's some risk there that you're not actually getting the protection that you think you are from this bill. Conversely, like there's other years where those guys that store everything and they sell it during the typical seasonal period, May, June. So if you're one of those guys, you may find yourself in a 2023 position where harvest prices were actually quite substantial, where a lot of corn was marketed then, and then your deep discounts on price came in the new year, right? Because there's a lot of corn left over, and we had another good South American crop. So I'm going a long-winded caution on relying solely on Farm Bill. I think when you combo Farm Bill and higher levels of crop insurance and some forms of marketing, then I think we'll probably find a lot of growers will actually do better in that mid threes than they will in the low fours. I know it sounds counterintuitive, but what you're doing is you're triggering double payment essentially, right? You're getting your full insurance payments. If you chose an elevated ECO type policy, there's a good chance that 350 corn is going to be a very good payment there. Plus your Farm Bill projected payments, plus some marketing. And if it's trade war that's not being fulfilled, there's also that chance we get market facilitation payments like we did the first 2 years of the trade war, right? That would be a potential third payment that we would be receiving too. So a lot of moving parts here. I think, Ben had a good point. Like it's hard to do a whole lot here when we know we have decent coverage levels, because the narrative changes tomorrow. If we've sold too much in the lower fours and all of a sudden we're in the higher fours, all these payments go away. This is not necessarily set in stone. Just because they raise the Farm Bill coverage doesn't mean that it's actually going to trigger a payment yet.
Right. Interesting question. James poses is you pay storage at the elevator, sell all the corn if you have no storage as an option.
That's a very good question, James. I mean, that's a hard question too, because elevator rates can change. Like we found in some years, like 2014, where storage there's plenty of corn that would like to go into storage. We see storage rates expand in those situations. So it may not is the juice worth the squeeze? If the cost is too high, it might not be. Now, if you've got reasonable elevator storage costs, then yes, that's the first way that I would probably consider trying to match up to that marketing year average. They do publish the percentages that they're sold, in prior years. So if you kind of match up to that historical percentage sold through that marketing year, step 1 to step 1, that would be your most like simple way to try to match up to the same marketing window as the marketing year average. And when we're talking about like how substantial can these payments be? Well, each entity can now get $155,000, right? And we're talking about just from like, let's just say you're a grower in Illinois, and the majority of your base acres is corn. Say 80% of your base acres are corn, and you have plenty of entity coverage. You don't have to worry about the caps. You might be at a $4 corn price at average yields. It could easily be over $100 an acre on just your corn side of the crop. And frankly, my personal opinion is that beans have a tighter balance sheet than corn, and we have a better domestic demand structure, more inelastic with these higher crush margins. I'm just talking hypothetical, but I wouldn't be surprised to see some sort of high multiple on that beans corn ratio. So you could find beans at $11 and corn at $4, right? And just hypothetical outcome, and actually come out okay if that were the case, because we have a decent domestic bean market. And that would be like, especially for the guys with the high corn base acreage numbers. There's a million different scenarios that can happen here, but I'm just kind of thinking about how do you position around that.
Yeah, it's a good point, Dustin. I think we we talk a lot about it just in terms of our philosophy. I mean, we use our software. We're identifying any yield or price scenario and visiting about profitability and talking about, what is an acceptable risk or return, for our operations. And I think what highlights this is I was having a conversation yesterday. And, it's easy to say, well, there's nothing to do here. And, we're just going to see how this plays out. And, that's kind of the narrative right now. And I get it. It sucks to look at this thing. But at the same time, I think if you dig deep into it and understand, a lot of if then type of scenarios, it could be the difference, because there's so many moving parts. I'd say more so this year than any other year, given the complexities of trade, the complexities of farm bill, the complexities of just overall fundamentals. Don't be lazy, to put it bluntly. Do the work, put the work in, and I think maybe, you can carve something out here. I mean, is that fair, Dustin?
Yeah, I think it's a good, I like looking at specific examples for this. Like, for example, if we're at 417 today, that could be one of the worst spots that we could ultimately get to if we have above average yields, right? For the guys that had higher levels of coverage, is that if they're looking at negative basis for their excess bushels, and they have to dump everything that's excess at 417, and they're not getting all these extra triggers, and they've got a negative basis on those particular bushels, that's probably going to be the lowest possible return that they're going to get for corn this year, if that's where we're at. So it's blue skies to the downside, blue skies to the upside from that point in time. And if you're looking at it just in a term of matrix of price possibilities, if we had a good estimation of yield, there are ways to protect the middle of the market too. There's premium collection strategies that can be done that say, hey, I'm willing to take less on the very, very low end and less on the rally to try to prop up the middle where I'm at now. And to your point, Dan, it's not like there's never a situation where you just say, well, I'm just going to throw my hands up and just see where it goes and say there's no other alternative to that. I agree with that. Like that may be a strategy to consider in those cases.
Sure. No, very good. Ben, wrap us up here this morning with some thoughts.
Yeah, pretty disappointed with how they refer to them as trade deals. And it looks more like just tariffs, which can be somewhat incendiary to some of our bigger grain trading partners. And then it's an executive order to delay that until August 1st. So I think when you look at our markets, which we can have really good markets and good export years, particularly in corn, and we just keep sort of making it worse and kicking the can down the road in the face of what appears to be a pretty good corn crop. So I think that you establish that we have a big corn crop, but we really need to get something more than tariffs on random countries because they're not participating, to solidify our place at the table in the export market. So
Yeah, I
it's
second
frustrating.
that. I second that. I'm I'm worn out with the back and forth, and Bassett says he's got an inbox full of people wanting to make deals, and we're just sending letters. So anyway, we'll get off our soapbox on that, but it sucks. Rye, let's touch on cattle real quick. Strong start to the week for fats and feeders, and looks like last week's hog slaughter was less than expected, which is interesting. So why don't you share a few thoughts with us here this morning?
Yeah, I mean, you just can't keep this market down. It's kind of the exact opposite of the grain markets. It's just nothing but optimism around the board here. I mean, you got a stabilizing beef market. I think that's kind of a good sign. Obviously, the retailers kind of showing up post-holiday in both places for pork and for beef. So we did see choice up 123. We haven't seen any cash yet, but it was a really strong close here. I think that kind of defied the expectation. Maybe you had a little bit of headline trade, maybe some current concerns about the flooding in Texas, really kind of impacting some transportation and just misplacement of cattle. So still trying to see how the dust settles on that. But again, we're just kind of seeing where kind of everything's at going into the week. I mean, Managed Money's still carrying a really long position here. They just tapered some of their feeder position, and feeders back up to new highs here. So, I mean, they're just really kind of seems like this is still the path of least resistance. Obviously, we're running into levels that I think most producers are pretty comfortable with looking at hedging a little bit more here. But overall, I mean, there just really hasn't been anything to kind of shake the confidence here in just about every facet, even with what we've seen in the cash market on the cattle side of things. I think the price action on the board is still going to give a pretty optimistic outlook here, just considering it just finished up pretty steady last week. So once again, just kind of defying expectations. I know everybody's kind of concerned that we're running into the potential for seasonal pressure in beef, and but it just, as of right now, it looks like it's trying to stabilize a little bit. So we'll see how that shapes up. But like I said, we're just coming in with a lot more confidence, I think, today than we were over the weekend. And on the hog side of things, stayed pretty firm, still traded under the 50-day moving average. It seems like that just overall, we got a little bit of a pop in demand. Carcass was a little bit higher. You had an $11 rally in bellies yesterday. So you're coming in with some pretty strong demand figures. There was no cash reported yesterday, so still a little bit kind of on the fence about that, but it does kind of feel like we're watching to see if there is that seasonal down here in pork, just to kind of keep the pressure on. At this point, Managed Money still carrying a massive position, 134,000 contracts, which we see as kind of a risk going into this last half of the year. So I think producers are just getting a really good opportunity just to kind of stay hedged here, at least protect some profit margins. And once again, I think all eyes are on cutout still, just for kind of near-term direction here and tariff news.
All right, buddy. Appreciate the update there. Just came into the open. We got September corn down 5 now, 398.5 is the last. August soybeans are down 6 1/4 at 10.25 1/4. And September Chicago wheat's down 4 1/4 at 5.44 1/4. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. It'll keep you up to speed on everything that's going on with AgYield. So again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. We hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.